Welcome back to the channel where I take pride in taking control of my financial situation and doing dividends different. In the world we live in where we have tons of information at our fingertips, it can make even the simplest things complicated, like picking quality dividend stocks. Did you know that there are over 5,000 publicly traded stocks in the United States, but only around 2,000 of them pay dividends? With so many options available, it can be overwhelming to figure out which stocks to invest in. That is why it's very important to have a list of criteria you can understand that you can apply to filter out the stocks that do not match your goals and your timeline. In today's video, I'm going to outline 3 simple and easy to understand metrics that I use when selecting my own dividend stocks. If you're interested in building a strong dividend portfolio, be sure to stick around for the whole video and subscribe to the channel for more financial insights and dividend information. But without further ado, let's dive into the metrics I use to select my high quality dividend stocks. So the primary metrics or criteria I use when selecting my dividend stocks are they have to pay and grow a dividend for at least 5 years in a row. The stock must have a 3, 5, or 10-year with preference on 10-year dividend growth rate above 10%. And lastly, the stock must outperform the S&P 500 over the past 10 years with dividends reinvested. After applying these 3 filters, we can narrow down the list of potential stocks significantly. For example, starting with over 5,000 publicly traded stocks in the United States, we filter down to only about 2,000 dividend paying stocks. From there, we further narrow down the list to only 737 stocks with a dividend streak of at least 5 years, and then to 125 stocks with a 3, 5, and 10-year dividend growth rate above 10%. Finally, by requiring the stock to outperform the S&P 500 over the past 10 years, we can further narrow down the list to only 87 stocks that met all of our criteria. 3 dividend stocks that currently meet this criteria are Broadcom, stock ticker AVGO, Monolithic Power Systems, stock ticker MPWR, and Home Depot, stock ticker HD. Now you might be asking yourself, what makes these 3 simple metrics so important? Allow me to explain. First up, we have the dividend streak of 5 or more years. This criteria ensures that the company has a track record of consistently paying and growing its dividends. A company that has paid dividends for at least 5 years shows a commitment to returning value to shareholders, and a track record of consistent dividend payments and growth can be a sign of a strong, stable company. When the market experienced a downturn in 2020 due to the COVID-19 pandemic, many companies were forced to cut or suspend their dividends. However, companies like Home Depot, stock ticker HD, which had a dividend streak of more than 10 years, continued to pay and even raise their dividend during this challenging time. Dividend growth rate above 10%. This criteria helps identify companies that are increasing their dividend payouts at a healthy rate. A dividend growth rate above 10% over a period of 3, 5, or 10 years shows that a company is not only paying dividends consistently, but is also increasing them at a significant rate, which can lead to a higher yield on the original investment and impressive compounding. Broadcom, stock ticker AVGO, back in 2018 was paying out $7 per share per year, while just 5 years later in 2023, they're paying out an impressive $18.40 per share per year, which shows the significant improvement in dividend returns in just those 5 short years. Outperforming the S&P 500. This criteria ensures that the company is not only paying dividends, but also generating strong returns for investors. By comparing the company's performance to that of the S&P 500 index, we can see if the company is beating or lagging behind the overall market. Monolithic Power Systems, stock ticker MPWR, has consistently outperformed the S&P 500 over the past 10 years with dividends reinvested, which shows that the company is generating strong returns for investors while also paying dividends. By using these 3 criteria, investors can narrow down the list of potential dividend stocks to a smaller, more manageable number of companies that have a track record of consistent dividend payments and growth, healthy dividend growth rates, and strong returns for investors in the form of capital appreciation. Next, I wanted to show you how you can use this criteria to build a dividend portfolio. When it comes to building a dividend portfolio, it's important to have a clear set of criteria that you can use to select your stocks that not only you understand, but align with your investment goals and strategy. In my opinion, the point of your initial criteria should be to eliminate a majority of stocks that do not fit your timeline or goals, which, as we saw, will present you with still far too many stocks to review on your own. This is where you can throw in secondary filters such as a payout ratio under 40%, a dividend yield between 1 and 2%, and or any other metrics that you understand and value to really shrink that list for your final review. Another thing that you can do at this point in your research is try to balance out your portfolio in terms of higher and lower yielding investments, as well as diversifying throughout different sectors to mitigate risk. Balancing high yield and low yield stocks is important because high yield stocks may carry more risk and low yield stocks may not provide enough income to meet your financial goals. By striking a balance between high yield and low yield stocks, you can potentially achieve higher total returns while also reducing risk. Also, by diversifying your portfolio across different sectors, you are spreading out your risk. For example, if you only invest in the technology sector and there is a downturn in the tech industry, your portfolio could take a significant hit. But if you spread out your investments across different sectors, such as healthcare, consumer goods, and energy, a downturn in one sector may not have as big of an impact on your overall portfolio. These are often pitfalls of many dividend investors where they focus too much on yield before they need to. Check out the video on my channel for how detrimental that can be to your goals of financial independence, or they fall in love with one or two sectors, which exposes them to even more risk if there is a sector correction in the markets. After applying the 3 criteria we discussed, I was able to narrow down the list of potential dividend stocks significantly. By selecting stocks with a dividend streak of at least 5 years, a 3, 5, or 10-year dividend growth rate above 10%, and outperformance of the S&P 500 over the past 10 years with dividends reinvested, I was able to identify only 87 stocks that met all of this criteria. Using these criteria and additional filters, I was able to build a diversified dividend portfolio that aligned with my investment goals and risk tolerance. By balancing high yield and low yield stocks and diversifying across different sectors, I was able to reduce risk while potentially achieving higher total returns. Over the past 12 months from February of 2022 to February of 2023, my portfolio using these same filters had money-weighted returns of 8.84% versus the Dow Jones, S&P 500, and NASDAQ returns of negative 1.59%, negative 7.69%, and negative 15.96% respectively. As you can see, through my own experience, I have found that focusing on these criteria has helped me select strong dividend stocks that have consistently provided growth and income over time. By using a clear set of criteria, using criteria I understand, and avoiding common pitfalls such as overemphasis on yield and sector concentration, I believe that I'm well on my way towards my goals, and you can be too. In conclusion, selecting dividend stocks can be a daunting task, but by applying a set of clear and effective criteria, investors can identify strong dividend-paying stocks that align with their investment goals and risk tolerance. By building a diversified dividend portfolio that balances high yield and low yield stocks and diversifying across different sectors, investors can potentially achieve higher total returns while also reducing risk and keeping things simple in the process. I really hope you all enjoyed today's video. If you found it helpful, please consider leaving a like on the video to help out my channel, and then subscribe and ring the bell because I post dividend related content 2 times a week. If you have any suggestions for other dividend related content you want me to cover, leave that in the comments down below. And if you like this video, please be sure to check out the other very helpful videos you'll see on your screen. But until next time,